This Chapter 1 provides an overview of the principal characteristics and salient features highlighted by the rating agencies for the global retail sector. The three principal documents we use in this module are Moody's Global Retail Industry Rating Methodology, dated June 30, 2011, hereinafter referred to as Moody's 1, S&P's Key Credit Factors, Business and Financial Risks in the Retail Industry, dated September 18, 2008, and hereinafter S&P 1, and S&P's Criteria Methodology, Business Risk/Financial Risk Matrix Expanded, dated May 29, 2009, which amends parts of the S&P 1 document and is hereinafter referred to as S&P 2. These documents and any others we mention in this module can be accessed via links you will find in the course outline that opens if you click the bottom left icon below this video. In total, Moody's rates 109 companies in the retail industry globally, at least as of June 30, 2011. These are defined to be companies whose principal business is to act as the final sales point to end consumers for wholesalers and manufacturers of food and non-food products, and representing approximately $330 billion of rated debt outstanding. The methodology described in Moody's 1 resulted, as of the date of that document, in senior unsecured credit ratings ranging from AA2 to CAA3. We note that some of the ratings appearing in that publication may have changed since its date. The retail industry is very diverse according to both credit rating agencies. In Moody's 1, the rating agency emphasizes that retail covers a large number of segments, including grocery store retailers, specialty apparel stores, and department stores, and also spans different business models, e.g. direct marketers, vertically integrated manufacturers versus pure distributors, and a wide range of formats, such as quote-unquote big box retailers and internet or catalog-based direct sales operators. Accordingly, retailers globally exhibit very diverse operational financial dynamics. Most retailers, however, exhibit typically the following financial characteristics. 1. The purchaser of the retailer's goods is a private individual or small trader. 2. The goods being purchased are principally physical goods or media content, although some retailers sell services, such as financial services, as a secondary component of their merchandise offering. 3. Purchasing frequency of goods can vary significantly, ranging from near daily food purchases to less than annual purchases of large consumer electronics or home goods. 4. A retailer can sell its product via a number of different selling channels, from physical brick-and-mortar stores to a direct channel such as catalog or internet. And 5. Some retailers solely focus on retailing, while others may also be manufacturers that retail merchandise that they manufacture in-house. S&P similarly acknowledges the variety of subsectors in which retailers operate and the similarities and differences between them. S&P groups together subsector types that have similar traits and that compete directly with each other for the consumer wallet for purposes of industry risk analysis. In North America, for example, S&P groups the following subsectors together analytically: supermarkets, pharmacies, and convenience stores; department stores, general merchandise discounters, and apparel stores. And non-apparel retailers, including electronics and appliances, home improvement/hardware, furniture and housewares, books, music, hobbies, sporting goods, and other specialty goods and services. S&P views the effect of cyclicality as the main risk differentiator between subsectors. Retailers selling staples, such as supermarkets and pharmacies, are less susceptible to economic downturns than retailers in home improvement, appliances, and apparel, where consumer purchases can be postponed when economic times become tougher. Key industry characteristics that one or both of the rating agencies comment upon include the following: a wide range of business risks. Business risk is a function of the products a retailer sells, the market segment in which it operates, the competitive environment overall, and the retailer's positioning within its product and geographic markets. For example, companies which focus on products with less demand variability, such as food and basic consumables, generally exhibit lower business risk. Conversely, specialty retailers have higher business risk due to cyclicality and seasonal volatility, product obsolescence, and fashion risk. The positioning of a retailer within its segment and the rise or fall of entire segments of retailing relative to others also add dimensions of risk. Discounters, for example, have globally taken meaningful market share in numerous product categories over the past decade. 2. Critical importance of execution, including tight logistics and customer service. A retailer must provide customers with the right product at the right time and price. Competition is often fierce, partly due to overcapacity or oversupply, and customer loyalty can shift rapidly, especially to the negative, if the value proposition of the retailer changes. Adding to this, the increasing commoditization of many retail product offerings has brought operating margins under significant pressure. Finally, the rapid growth of online shopping is beginning to erode traditional store sales, exacerbating retail space overcapacity. 3. High fixed cost, capital intensity, and operating leverage. Retailers typically require significant investments in fixed cost, including rent for retail outlets and employment costs. Growing retailers often become even more capital intensive due to investments in warehouses, distribution infrastructure, and high-tech inventory management systems. These fixed assets need to be updated, refurbished, and relocated frequently to provide optimal returns. Different growth models. Number 4. Organic growth is the principal growth strategy for most operators, consisting of either new stores or growth in existing stores. Although some acquisitions occur when organic growth is limited, including via international expansion. Retail formats do not always travel well, however, and international expansions typically take time and multiple iterations before being deemed successes or failures, leading to substantial write-offs in the latter case. In addition, overseas infrastructure requires significant upfront investment, limiting some of the benefits of size. Number 5. relevant markets are, in any event, usually local or regional in nature. While a few retailers boast significant geographic diversification, most retailers remain predominantly local or regional businesses. It is important to understand the regional context in which a company operates to properly evaluate its business model. We will say more shortly about important regional differences exhibited by the retail industry. 6. Significant seasonality and fashion risk. Non-food retailers in general face significant seasonality, with a high concentration of cash flow during holiday seasons. Severe seasonality can result in a make-or-break period for a retailer, magnifying the financial impact if the retailer misses a trend, carries obsolete inventory, or cannot price its products at a competitive advantage during a key season. And finally, 7. Strong influence of consumer spending and employment. The retail industry is severely affected by macroeconomic factors, including unemployment, housing prices, and consumer spending. Retailers that sell non-discretionary products tend to weather economic downturns more easily, but no retailer is immune from such downturns. When times are difficult, retailers may be forced to lower prices, reduce margins, and write off inventory. Mall traffic, on which many retailers are dependent, may vary for reasons such as changing consumer preferences or changes in local demographics, and even due to other variations. Consumer credit purchases, finally, have been a major driver of sales in recent years, particularly in developed markets, but are likely to become increasingly constrained by record levels of household debt. Key strengths of the retail industry include the following. 1. The pivotal role of the retailing sector and consumerism in the economy. 2. The rapid industrialization of China, India, Eastern Asia, and the former Soviet bloc, which is spurring demand and overseas growth opportunities. 3. The substantial improvements in operating, supply, and inventory management capabilities, which have lowered costs, inventory, and working capital risk. 4. The advent of low-cost, high-quality goods from emerging industrial countries has spurred consumer demand. And finally, 5. The substantial consolidation in various industry subsectors, such as electronics and books, has given survivors significant leverage over suppliers and increased economies of scale and name brand recognition. Before completing this introduction, we summarize Moody's observations on important industry differences across the principal regions of the world. In the United States, Moody's notes the very high fragmentation and overcapacity of the industry, driven in part by the lack of regulatory or geographical barriers to entry. This gives U.S. consumers a high level of substitution for both goods and venues in their buying decisions. In Latin America, some countries like Brazil are enjoying high consumption due to their strong economic growth, boosted by notable events such as the 2010 World Cup. Moody's considers the European market to be more regulated, with more restrictive planning permission impeding the entry of sizable new competitors and providing a degree of qualitative support for the rating agency's assessment of existing retailers. In food retail in particular, the concentration of the major operators is significant and is reflected in high market shares. Japan is characterized by the continuing coexistence of strong and weak performers, and by investor and lender tolerance of low profit margins. There are very few instances of predatory pricing strategies that kill off weaker companies, so the country remains overstored. At the same time, the greater commitment to long-term relationships at every stage of a business's development results in a more stable operating environment for rated Japanese companies. External shocks such as unexpected foreign exchange moves and rising material costs are often vertically shared by retailers, wholesalers, manufacturers, and material suppliers, with no single participant in the chain expected to take on the full impact of a shock like this on its own. Consequently, operating margins of Japanese retailers are relatively narrow but stable, and profitability and efficiency are lower than those of peers elsewhere. More generally, senior executives of Japanese retailers, with the acquiescence of their shareholders, prioritize operating continuity to balance the interests of all stakeholders, including shareholders, lenders, local communities, employees, and trade partners. In China, the overall shopping experience, rather than price differential, is becoming more important, especially for mid to high-end non-discretionary retailers. Wide geographic coverage and execution capability are critical, with consumer taste and spending power varying considerably across different regions. Australia, lastly, is a good example of a highly concentrated market with a small number of very large supermarket chains, such as Woolworths and Coles. These have significant national retail footprints and marketing power, and entrenched real estate positions, all of which allow them to maintain dominant positions. As of early 2011, Coles and Woolworths had been engaging in an aggressive price war over basic staples, such as milk, bread, and eggs, raising the specter of margin compression. But the industry remains strong and highly profitable by global standards. This completes this chapter 1.